Hello, everyone, and welcome to Macros with your host, Tony. So, hopefully, you can hear me clearly and sound is all good for you. If you are joining me live, hopefully, as said, you can see my screen clearly. We've got about 30 minutes to the release, so we've got quite a bit to cover, as always, with the EIA inventories prep. So, let's get into it. So, what is it? So, what it is, it represents a weekly change in crude, gas, and distillate inventories. And what it affects mostly or mainly is transportation, and also those companies that use oil to make the goods and products that use that, such as plastic, and that's everywhere. So it has a big effect on not only the crude oil market, but also for globally as well, and also for the country itself. And then if we continue on, so why is it a release to watch? Well, the main reason being it can be quite volatile. So what we got last week, we had, if we looked at our deviations, so we'd seen about 50 ticks up, about 50-cent move, and then about 30 minutes later, it was up by $1.74. And the prior week to that, there was about $1.27 move on the initial candle. So can see some quite big moves in the market when sentiment isn't impacting it so much, or if there isn't any sentiment, or if there isn't any other big major bits of news impacting the crude oil inventories release of the crude market. Then, how does it affect the markets? So the release itself. So when more oil is added, that's negative for oil, or when there's a build in oil inventories. Usually, of course, when there is more supply that is added to the market or globally, that would lead to lower oil prices. Of course, we've got to think about supply and demand. The more oil there is, the less demand that there is. And then on the flip side, we see that if there's less oil added, or if there's a draw in inventories, then that's positive for oil, i.e., that we will see an appreciation in crude oil prices. Again, supply and demand, the less oil that there is available, the higher that the demand is for that oil. So the price will naturally go up. And we've seen that historically in the past when you had the energy crisis back in the 70s. Recently, what we've had as well with COVID and also Ukraine and Russia, that's what's happened when there is a low demand, when there is lower high demand, or when there's low demand, you'd see lower oil prices, and when there's high demand, you'd see higher oil prices. Okay, so triggers then for the release today. So according to economists, they see crude with a high estimate of 2.8 million and with a low of minus 2.6 million. Gasoline, high estimate of 1 million with a low of minus 1.4 million. And distillate, a high of minus 0.9 million with a low of minus 2.7 million. So if I just bring up the other or the rest of the forecast as well. So forecasted today, the median estimate where markets or economists are expecting EIA crude oil inventories to come in as a draw of minus 0.6 million compared to the prior of 0.692 million. Gasoline inventories expecting a build to minus 0.8 million compared to the prior of minus 1.573 million. And EIA distillate inventories are forecasted to see a build as well, or slight build at minus 1.387 million compared to the prior of minus 1.449 million. So overall, the economists are expecting a build in inventories data, and for the headline, as said, a draw. One other thing that we've also got to be aware of is with the API data that we always get the day beforehand or the night beforehand. That is something that traders have a focus on, because what it can do is it can show there sometimes is a correlation with the API data or the private data and the official uh, EIA data from the government. So there isn't, as I said, there isn't a strong correlation, but there is that correlation there. So for some traders, or for a lot of traders, they have a focus on that data, and it could give them an inclination as to what to expect for the following day. But as I said, doesn't always match up or marry up so well. But in the past 2 weeks, we have seen a correlation between the API data, particularly the headline data, and the EIA data that we received the day after. So API, the actual was minus 3.479 million compared to the forecast of minus 1.167 million, and the prior was 4.78 million. So overall, there was a bigger draw on the API data. Hey, Galaxy One, how you doing? We're all right? Good to see you again. But yes, so the API crude oil stock change data came in at a draw, or much bigger draw than expected. And then the distillate stock change had seen a draw as well of minus 4.457 million compared to the prior of 0.431 million. And gasoline stock change saw a draw as well of minus 4.5 million compared to the prior of minus 3.91 million. So overall, the API data had shown a draw, or a very strong draw in private data. But as said, yet to be seen whether or not if that correlation does marry up again as it did last week and the week before with the inventories, or the EIA crude oil inventories data. So if we move on. So the market reactions: April 6th, we had seen some weakening. April 13th, they weakened by $1.30. April 20th, it was up by $1.27. And then this week, what we've seen, if I bring up the deviation for you, and we can see that. So the deviation then for last week and how much EIA inventories moved. So we'd seen overall there was a bigger draw compared compared to the slight build that we'd seen in EIA crude inventories data. So for that, we'd seen about 50 ticks towards the upside, or about 50 cents. And then after about 10 minutes, it was up by 89 ticks, or 89 cents. And then the peak as well. So this is one thing. So a new measure that I've included is when did it actually move back to its original level prior to the release. So the peak, it took about 34 minutes. Excuse me. So the peak was at about 34 minutes, where it was at 174 ticks. It was up 174 ticks, or $1.74. And actually, so just a slight correction of what I said. What I mean is, when it started to move back to its prior level, or had moved back to its prior level, last week it took about an hour or so for that to happen. After the EIA inventories data, so 34 minutes, we'd peaked at $1.74, or up, or 174 ticks up. And then after about an hour, we had seen EIA, or crude, move back to its prior level before the release. And we can see the week prior to that as well, April 20th, when there was a bigger draw than expected. We've seen a much stronger reaction when we'd seen there was about 11 million deviation from the forecast figure on the headline, and then you had the distillate to support that figure too. And we'd seen about $1.27 move towards the upside, and then after about 10 minutes, it was up by $1.18, and then about 52 minutes later, then it started to then it moved down past its prior level to the release. So what we're expecting and one thing to expect is when there is an overall, let's say, build or draw in inventories data, then if we see an overall build, we'd expect to see some movement towards the downside. That could be a potential scenario, and vice versa. If we see a bigger draw overall in the inventories data, then we'd expect to see what we'd seen last week with the data, where we'd see an appreciation, or could potentially see an appreciation in crude oil. So that's one thing to expect. Now, when the data is mixed, where there isn't really a strong overall build or draw in the figures, then that could mean that there might not be too much of a reaction, or there might be some choppiness in the or choppiness on US oil or Brent crude oil. But so just to clarify then, so we'd expect, as said, what we had seen with the triggers. So the economists seeing 2.8 million as a high estimate for the crude oil inventories data, with a low of minus 2.6 million. Usually, so during the Ukraine conflict, or at the beginning of that, we were expecting about 6 million deviation. But even then, there wasn't too much of a reaction. There was an initial reaction where you'd see like a flash move towards the downside, and then back up to its prior level, and then it would kind of continue its movement, or there wouldn't be any reaction at all, as we'd seen here way back on February 24th, where there was no reaction because sentiment was driving the markets much more so than the reaction to the inventories data. So I think what we're looking for today, I think instead of going for 5 million deviation, I think we'll be looking at around 3 million deviation, at least on the headline figure, the EI inventories, EI crude oil inventories. But then we would look for support from the other figures too, in the same direction. If they also see, let's say, if crude oil inventories is a draw or a build, and there's a 3 million deviation, we would look for the other data to be in line with either crude being a build or a draw to support that. Or one other scenario is, again, what we'd seen last week on April 13th, where you had the headline figure that was a much bigger build overall compared to the other two figures. So if we do get that, then the crude oil inventories data outweighs the other two releases, then you'd expect a movement in whichever direction it would go. If it's a build, you'd expect it to have a stronger reaction towards the downside, or if it's a draw, then vice versa, strong reaction to the upside. And as we'd seen the April 13th, with about an 8 million deviation, even though there was totaling these two bits of data together, there was a 5 million deviation, or 5.5 million deviation. The crude oil inventories data was much bigger, and we'd seen about 132 ticks towards the downside, or about $1.32. So there's variations of different scenarios of what we can expect from the crude oil inventories data and how that can affect the market. And then going back to so if we bring up the previous market reaction then of what we had seen, I'll bring it here for you. Okay, so this is about 10 seconds before the release for last week. Play that here. Okay. Ooh, no, that's the wrong release. Apologies. Let me get the right one for you. That was the That was a week before. Let me grab it up here. There we go. All right. Back a bit. Okay, there we go. So yeah, this was last week's data that we had seen. About 5 seconds. So I said there was an overall draw in the inventories. Okay. And that had caused the move towards the upside, as we'd seen there from the data. So as I said, the other two bits of data outweighed or was bigger than the headline figure itself, leading to an appreciation. Yes, my mouse is hovering over that in the video, just to kind of highlight that fact there. Okay, if we kind of skip ahead a little bit. So yeah, so there was that. So it wasn't. So we'd seen the overall draw, a flash move towards the upside, and then back towards the downside, and then we'd seen a continuation of move towards the upside for that data. Keep moving forward. Okay, and then we also had the headline of Germany seeking a transition period for Russian oil ban, according to officials. So that would also have helped a little bit too. But again, as said, that was the prior release. Okay, so again, still up on after the release. Go away from that now. And now I want to go through some sentiment. So this is, I think we might get a similar reaction to what we had in the past, where there might not be a reaction to the release. And in actual fact, instead of looking for about 3 million deviation for the headline figure, I think we'd want to look for about 5 million, maybe. The reason being, so let's just go through some of this sentiment here. So you have China. So China seeing a big pump in pipeline gas from Russia. I'll see domestic gas production rise 8 to 10% this year. And according to Citi, what they said, that's going to loosen up markets and provide a significant amount for Europe, and see progressive reduction in European and global gas prices. You've also had on May the 4th, China as well with their lockdowns. They're looking to, they're doubling down on their lockdowns in Beijing. And you've also got some parts in Shanghai, but that's more or less open up a bit more. But that's also weighing on sentiment as well. Of course, when there is a lockdown from China, then that would mean that there is less oil needed, or the demand is less. So that would drive oil prices down. But what we've seen today, we've seen about 51 new COVID cases in Beijing. Although that's quite low compared to what we'd seen previously, when there were about 1,000 cases in Shanghai about 3 weeks back. They're sporadic. So there is still, according to the Chinese government, there is still a need to keep those lockdowns to try and curtail those sporadic cases popping up and appearing in different areas in China, particularly in the cities. Germany and Europe. So you had on May the 2nd, Finance Minister Lindner said that the government is open to discussing an oil embargo, though transition from Russian oil will take longer than coal. On April 30th, you also had the EU saying that they're set to propose a ban on Russian oil by the end of the year. And May the 4th, so this is where everything changes. Okay, this is why I think we might need to see a much bigger figure from the inventories data. You had von der Leyen at 2:50 a.m. Eastern Time. You had her saying that we will phase out the Russian supply of crude oil within the next 6 months and refined products by the end of the year. So again, when there is less oil in the markets, remember that will drive up the price of crude oil. Okay, so I'll show you the chart of what we've seen today with the reaction from that. We'll bring that here for you. So this is what we'd seen after that headline had come out. Crude oil still up by 2.6%, but this is the initial reaction. So we'd seen that move towards the upside, and ever since then, it's since the morning, it's stayed relatively, or it's stayed above 100, stayed above $105. So we're at $106 so far, and we could what that could mean. So usually when there is when there's negative or positive sentiment or positive negative bits of news that comes out the day before or during the week of the inventories data or of that release, sometimes that sentiment can outstrip the importance of the release in its entirety. So we might not get a reaction or too much of reaction from the release itself, but we might actually see what we've seen in the past, where on April 6th, we've seen about 42 ticks towards the downside, and on March 30th, we'd seen about 22 ticks up and about 59 ticks down. So there wasn't too strong of a reaction from the inventories data, or a really strong reaction compared to what we've seen recently and also in the past as well. So that's something I think that might mean that the data itself could be, we might not get a reaction at all. So I think instead of a 3 million, we would look for about 5 million deviation from the crude oil inventories data, maybe as one scenario, or we'd look for an overall build or draw in the inventories data. So again, as said, that's what's driving the oil markets so far today. China stuff not really doing anything or impacting that too much today so far. Okay, so back to the presentation. Also, you had India saying that they want cheap oil from that they want cheap oil from Russia, and they're looking for a discount below $70 a barrel. Usually, their normal consumption is about 15 million barrels per day, or around 10% goes from Russia to India. Overall, India imports about 85% of the oil from other nations. So it's quite a huge amount that India consumes globally. So with this scenario where Russian oil isn't favored, or might not be favored, or might be diminished, or the reliance might be diminished in Europe, its biggest consumer, besides other nations or other blocks, then India and other smaller nations could be, of course, India's not a small nation, but India and other nations that don't really have anywhere else to go in looking for oil, then it could mean that the price of oil would, one, you have the initial reaction of crude oil data, or of crude oil being much higher because there's less demand in Europe. But on the flip side, you could have where the Russians could drive the price down instead to make oil cheaper. So it could mean that the oil prices could go further down. Just seeing some OPEC headlines, by the way, live here. So OPEC plus JTC meeting ends without making any oil demand growth forecast revisions. That's according to two sources. A reminder, they do have their OPEC meeting tomorrow, so just to bear that in mind. Okay, moving on. So with Europe then, so Europe received about 720,000 barrels per day from Russia through its main pipeline last year. You've also had countries such as Hungary and Slovakia who haven't supported or don't support a quick cutoff from Russian energy. by the end of this year, or by, well, at least by 6 months. So what the European Union is doing is allowing them to wean themselves off of Russian energy by the end of 2023. We've got about 5 minutes left till the release. So investment bank views JP Morgan's Diamond saying global energy is precarious. If oil goes to $185 a barrel, it'll be a major problem for people, and we should do everything that we can today, and more oil and gas must be pumped. Then Citi also adding to the earlier comments as well that China oil demand is down more than 1 million barrels per day year to date, and doesn't look like that's going to come back anytime soon. So you've got a mix of views from investment banks too. Well, more or less, you have the investment banks saying that, one, oil prices are going to be higher if we don't resupply that missing Russian oil or Russian energy. And two, you'll have on the other side where China, if there's a loss in demand because of the lockdowns, that could drive prices further down. So those are the two bits there from JP Morgan's Diamond and Citi's. JP Morgan's Diamond actually said that today, just to make you guys aware. And then, of course, just looking at our chart or this image from the BBC, something that I've shown you last week as well. But I think it's always good as a reminder to understand how much Europe receives from the EU. Europe receives from Russia. So about 35% was what is the demand? What was the demand in 2020? Now it's up about 36% in 2021. 2022 this year, more or less similar to 2021 with Russian energy. And then you have Norway being the second largest, and then everywhere else you've got Qatar, Nigeria, Trinidad and Tobago, Algeria, and hey, it's us, the UK, with about 3%. So again, if we're looking, or if we're expecting a loss of supply from Russian energy to the EU, then that's going to be quite a big chunk that's going to be lost from the market, from the market there. Okay, about 2 minutes left. Let's go back to. Let's actually look at our website and get that ready. Okay. Also, whilst we've got about a minute left, so if you like what we've shown you so far, remember you can subscribe to our mailing list to stay up to date with the events for the week ahead via here, if you liked and you want to see also the replay of this video. Of course, it is going to be on YouTube, but if you want us to, if you don't look at YouTube too much and this is kind of new to you, we can send that there to you. We've got about a minute. And also financial juice, where we get the release of the figure. The main thing is, if you want to stay up to date with the current sentiment and what's going on in the markets, as we had seen with the earlier headline of von der Leyen causing that huge move, then sign up to Financial Juice and you can get a 7-day free trial of our service as well. That means you get no ads, you get real-time news, no delays in that there, and also you can set your economic triggers here on the side as well for what you're looking for in regards to the figures for a particular release. Okay, so let's see how much sentiment has affected the markets, or how much it affects the release today. Go about 15 seconds. Also keeping an eye on tick strike as well. So if I just get my crude up here. Okay. Okay, that's a build on the forecast of at minus 1.302 million compared to the forecast of minus 0.6 million on crude oil inventories data. So a bigger build than expected there. And then gasoline inventories, a draw on the forecast, a draw of minus 2.230 million compared to the forecast of minus 0.8 million. Distillate also a draw on the forecast of minus 2.344 million compared to the forecast of minus 1.387 million. So crude oil inventories data, or the crude oil inventories data showing a bigger build isn't a big build overall compared to the other two figures coming in are much stronger than their forecast figures. Just seeing a little some movement towards the downside here on the US on WTI crude oil. If we calculate our deviations too, and we can see what we get or what we have. So if we were looking for okay, so there's about a 1.9 million deviation from the forecast for the crude oil inventories data. Gasoline. Okay, well, 1.43 million deviation or 1.4 million deviation. And then distillate. Okay. All right. So, distillate there's about 0.9, about 900,000 or 950,000 deviation, and gasoline about 1.4 million deviation, and crude there was a 1.9 million deviation. So, did see that initial move towards the downside. If we count the ticks, then what we'd seen on the initial move, not really a strong reaction, but there's about 55 ticks, 57 ticks towards the downside, or about 57 cents off of that figure. Okay, so again, so yeah, there was that move towards the downside, and now seeing that reversal happen much sooner than we had seen with the other EIA inventories releases and data. So if we're looking at let's also look at some of the other areas too. Okay, so Brent. Mm-hmm. That is not new. Okay. All right. We'll see what the market does with this. So, as I said, there was a bigger draw overall. Did see movement towards the downside from the headline figure. Deviation overall, as said, there was about 1.9 million deviation on crude data. So it wasn't outstanding or huge deviation. And gasoline and distillate made up about 2.3 million deviation in total. Just a rough calculation there. Okay, So if you liked this as well, and you like this live stream and you found it useful or helpful, don't forget, as said, we put the link in the chat for you to be able to sign up to that mailing list and be able to stay up to date with what to expect for the week ahead. I will be posting this video out as an email or via email, so you can watch it back if you wanted to have a look at it that way there. But also Financial Juice Pro as well, so where you get the figure, you get real-time news. Okay, news is very important when you're considering about managing your risk or understanding what's going on and what's driving the markets. So if you were to see the earlier headline, if I put in, if you were to see, if that did appear on your, if you seen crude oil inventories or crude oil, move towards the upside, but you didn't understand why, well, Financial Juice is a place to come along and see what the headline was, and also be able to understand why it would have moved. So if you want to stay up to date and be able to manage your risk and know what's going on, then not only do we provide voice and text, we also get real-time economic releases as well. And then, of course, finally, with TickStrike. So TickStrike, what I'm currently using at the moment, what you can see on the screen here. You can also sign up to that for a 7-day free trial as well. And again, just showing you how you can also listen to order flow. Order flow, if you imagine, if you're in the trading pits and let's say that the markets have opened or there's some big bits of news or something big has happened, you would hear the guys and gals shouting, buy, 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 sell, 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 all the mix of that noise. Now that noise has been translated into TickStrike, where you're able to hear the order flow and hear what the market is saying, or what that particular asset is saying. So of course you have your different levels of sensitivity. So I've set mine at 1, so I can constantly see it go off, and I've muted the sound for now, but you can hear there's a sound as well. So it's not only a visual product, but it's also an audio product too, if you wanted to use it that way. And you can increase or decrease the sensitivity to as much as you want. So the higher you increase the sensitivity, the less, let's say, notifications or sounds and visual moves or visual changes that you see on TickStrike on that asset. So if you're looking for a lot of movement and a lot of volatility, a lot of buying or selling, then you'd want to move that gauge higher, let's say. But if you want to see what's going on, if you want to see a lot of visual moves or sounds, when the markets are quite volatile or very, very volatile, then by all means, then you can put it all the way to 1 if you want to. But it's all how you want to have a look at it and how you want to utilize it. The link is there in the chat for you to be able to watch a tutorial video too, or an explanation as to what TickStrike is. That is up there for you. But again, ladies and gentlemen, thank you very much. Don't forget, later on, we have the FOMC rate decision. Okay, so there's a 50 basis point hike that is expected from the Federal Reserve from 0.5 to 1%. Most of the markets have priced in for a 50 basis point hike, but we'll go through that later on at 1 p.m. Eastern time, an hour before the release. But if you want, I'll also copy and paste the link here for you, so you can watch that or join us later on there as well. But bear in mind, for anyone who does sign up to a mailing list, you do get the links to all of these videos as well. Don't forget to like and share this video if you enjoyed it, and also subscribe to our YouTube channel as well if you've liked it, if you like the kind of content that we're putting out. All right. Other than that, ladies and gentlemen, thank you very much for your time. Hope that helped you with your trade today. And yeah, it's cleared its prior level. Or it's cleared that prior release level. We'll see if that stays down from the release. Alrighty, thank you very much. I will see you shortly, or I'll see you later on. Goodbye.